Welcome to Alu Speaks with Alu Patients. Today we'll be discussing on the topic the pro forma financial statement. This is under the course Corporate Finance. We are on the fifth topic of Modules 2. At the end of this topic, we should be able to define what a pro forma financial statement is and know the reasons why a pro forma financial statement is created. And most importantly, we would understand how to create a pro forma financial statement and some of the underlying assumptions that guide the creation of a pro forma financial statement. I realize that some of us do not have a business-oriented background. However, do not worry. I will be breaking the course down to be as simple as ABC. So, what is a pro forma financial statement? We all know what a financial statement is. A financial statement is what tells us what has happened in the last preceding year. But a pro forma financial statement is a financial statement that is predicting the future. It is a financial statement that tries to tell us what the future holds for the firm. It is made up of estimations and projections. It does not represent an actual financial statement, but a financial statement that is made out of forecasts and educated guesses and assumptions. The word pro forma comes from the Latin word as a matter of form. This means that a pro forma financial statement is simply a form of financial statement. The assumptions and forecasts that are used in preparing a pro forma financial statement is based on past financial statements or past market trends and even on human personal judgments. Why do I say this? It is because historical data alone from financial statements and even past market trends is usually not enough to show a real indication of what the future holds. So human judgment is usually very necessary to add to the mix in order to get an educated judgment. So we can see that understanding how to prepare a pro forma financial statement is a very useful skill every potential manager should be able to confidently use, as it is the job of managers to project assumptions on what may happen in preceding years in their firms and the implications of future financial projections. So what is this pro forma financial statement used for? It is used for planning and decision making. It helps management to plan ahead because it's a predictive tool. Apart from planning ahead, it also helps managers to estimate the future profits and anticipate any future financial needs of the firm. And this will enable the company to prepare for growth or any downturns that may happen to the firm. It helps investors and managers to analyze potential projects for their viability or otherwise. And even lenders, they require this projection for them to assess the firm's ability to repay loans as at when due. And investors also need these projections to know if the firm is financially stable. It helps the firm to analyze risk and create multiple scenarios, like breaking down the scenarios into best case scenario, expected scenario, and even a worst case scenario, so that they will be prepared for whatever outcomes happens. It helps to also predict future cash flow of the company. That way, it ensures that the company has adequate liquidity and working capital management. Apart from the fact that it is a way to communicate the company's plan clearly to investors, to banks, and to other stakeholders. If you are still here with us, please don't forget to subscribe, like, share, and hit on the notification bell. And do not hesitate to drop a comment or two if you need any area for clarification. I guess we still remember what a financial statement looks like. It is made up of the income statement, the balance sheet, and the cash flow statement. The income statement is that statement that tells us about the revenue and the expenses of the business and how it results in a profit or a loss. But hopefully, I hope it doesn't result in any loss. And the balance sheet is a snapshot of what we own as a company, as well as what we owe to third parties, as well as what we owe to our shareholders. And lastly, we have the cash flow statement that tells us about the financing activities, the operating activities, as well as the investment activities. This is just me trying to refresh our brain of what a financial statement looks like, which I know and I expect we already are familiarized with. Before us, we have a specimen of a financial statement. Let us use it as our guinea pig. Let's explain the workings of a pro forma financial statement using this financial statement before us. Projections in the income statement is usually made as a percentage of sales. Why is this so? This is because sales is a revenue driver. Sales is what actually represents growth in the business, in the firm. Therefore, when creating a pro forma income statement, most of the items in the income statement would increase with sales spontaneously. And why is this so? This is because sales usually have a direct impact on most of the items in the income statement. So as you prepare your income statement, all the items on the income statement will increase with the same rate as sales, except otherwise stated in the question. When preparing the pro forma financial statement, the percentage is the tool that is mostly used. Now, going back to our specimen financial statement, looking at the income statement, we can see the sales figure there is 50,000. And cost of sale of 27,000 was reduced from it to get your gross profit. Then an operating expenses of 19,500 was reduced from that to get operating income. After that, interest expenses of 2,080 was deducted from that to get net income before tax. After that, tax expenses was reduced from it to get your net income after tax. And we can see that the net income after tax was divided equally between dividend holders and retained earnings. So to create a pro forma invoice from this, we said that the sales figure is the driver. And the question is telling us that we should make a projection of 12% of sales, that sales grew by 12% higher than the previous year. And the pro forma invoice is simply saying that if we increase sales by 12% higher, we should increase all other items in the income statement by 12% higher. That is not so difficult. So let's do it. Now we have increased it, we have projected it by 12% higher. The sales figure has moved from 50,000 to 56,000, and every other item in the income statement have moved spontaneously according to sales, with also an increase of 12%. That is simply a pro forma income statement. However, in reality, all items in the income statement does not increase spontaneously with the same rate as sales. What I'm saying that in reality, not all expenses varies directly as sales. Some of the expenses have some fixed elements in them. For instance, rent would not vary directly with sales. The amount of sales you make in a year should not affect your rental payment, as your rental payment is increased at the discretion of your landlord, not according to your sales. However, you can anticipate a likely change in your rental expense with the knowledge you have about your landlord's discretion. Another example is salaries. Salaries that are paid to workers are usually fixed. So long as those workers, those employees are not on commission, their salaries are usually fixed and it's not based on the volume of sales. And a change in their salary is at the discretion of the human resource department and not as a result of the sales figure or of the sales department. Another example is amortization and depreciation. We know that this figure is gotten from the fixed asset section of the balance sheet, and therefore it is not even possible for it to even vary with sales. Also, interest on loan is not an item in the financial statement that can vary with sales. However, changes in interest can be based on a projected future borrowing of the investors. What about dividends that is being paid to shareholders? This does not even, it cannot even be as a percentage of sales, or nor does it vary with sales. It is based on the numbers of ordinary shares. If the numbers of ordinary shares in the preceding year increases, that will also determine the dividend payout ratio. However, when the question is silent on all these facts, we simply assume that all the figures in the income statement they vary directly with sales. What am I saying? I'm saying that if the question is silent, you need to assume that all items in the income statement they vary spontaneously with sales. Now, let's discuss the balance sheet before we enter the pro forma balance sheet proper. A balance sheet is broken down into two sides: asset on one side, liability and equity on the other side. And it's called a balance sheet because these two sides must always arrive at the same figure. It must always arrive at the same balance. And these assets are still broken down into current assets and fixed assets. And the liabilities too are also broken down into current liabilities and long-term liabilities. Even the equity is also broken down into ordinary share capital and retained earnings. I am sure we are familiar with all this, but I just want to refresh our memory before we proceed. Now let's discuss how these items react with the pro forma statement. All current assets are assumed to increase with sales projections, except cash. We remember that our current assets includes items like debtors, cash, inventories, marketable securities, etc. And all these items, they increase spontaneously with sales. Now the fixed assets. If the company is working at full capacity, we would assume that its fixed assets are all being utilized. Then a change in sales may equal a change in the value of fixed assets in the balance sheet. However, if the firm is operating below full capacity, then an increase in sales may not lead to a spontaneous increase in the values of all the fixed assets. This means that we have to listen to what the question says about them. If the question is silent on whether or not the firm is operating at full capacity or not, we have to make some assumptions and judgments. What I'm saying here is that the value of the fixed assets are based on judgment. They are discretionary items. So we have to listen to what the question tells us about fixed assets so that we would know how they react in the pro forma balance sheet. Current liabilities. We assume current liabilities will change spontaneously with changes in sales figures, except for short-term loans, because short-term loans has no direct relationship with changes in sales figures. Now, long-term liabilities. We believe that long-term liabilities cannot be affected by changes in sales, as long-term liabilities are liabilities incurred at the discretion and judgment of management. Now, retained earnings. Retained earnings is also a ratio that is decided upon by the judgment and discretion of management. So sales does not have an impact on it. Changes in retained earnings depend on if the firm decides to issue new shares in the projected years and the ratio of the profit not shared as dividend in the projected year. This means that if retained earnings and numbers of shares are not affected by changes in sales, therefore dividend paid also cannot be affected by changes in sales figure. We remember that dividend paid is that amount of profit that is not retained. Because of these many assumptions following the preparation of the pro forma balance sheet, the balance sheet asset side may not equal to the liability and the equity side. And we all know that in the accounting equation, it says that the asset side must always equal to the liability and capital side. That is, the asset side must always equal to the liability and equity side. So what do we do in such a situation? We simply plug it. That is, if there is a difference, we plug that difference. If the plug is needed on the asset side, we label that difference as cash. But if the plug is needed on the liability side, we label that difference as external financing. I seriously hope you are all following, because I know I am swimming in deep accounting jargons right now. Now, let's see if we can tackle the balance sheet specimen we were provided. Our balance sheet for 2001 shows debtor of 1,500. That is our current assets, and a fixed asset of 7,500, making the total asset 9,000. Then on the other side, it shows creditors of 2,500. Shares, ordinary share capital of 1,000 and retained earnings of 5,500, making that 9,000. So we can see that the asset side and totals 9,000, and the creditor and the equity side totals 9,000. That is how a balance sheet ought to be balanced. Now let's look at the question. Number one, it says no capital will be made in 2002. It means nothing was added to fixed assets in 2002. That is, fixed asset remains 7,500. Number two says amortization of capital for 2002 was projected to be 500. We all remember what amortization is, right? Amortization is a fall in the value of our intangible assets. Example of such intangible assets is goodwill. And since there is a drop in intangible assets, which means amortization of 500 will reduce our fixed asset from 7,500 to what? 7,000. Number three says new issues of shares will produce net proceeds of 1,000 in 2002. Meaning in 2002, more ordinary shares were issued. In the previous year, we had share issues of 1,000. Plus the current year, we had another new share issues of 1,000, making the total share issued in the preceding year 2,000. Number four says sales figure will increase by 12% in 2002. We already know that. We've handled that in our income statement. It also says it will also bring a corresponding increase in account receivables. This means account receivables, which is also known as debtors, for 2002 will increase by 12%. Like all the other items in the income statement, we can see our debtor there as well, 1,500, and if it increases by 12%, it becomes 1,680. Let's proceed to number 5. Number 5 said net income for 2002 was forecasted as 954. We are expecting to make a profit in 2002 worth 954. Okay. And number 6 is saying dividend payout is said to be 50% of net profits. Forgive the typographical error. That is supposed to be 50% written there, not 5%. Therefore, if 50% is paid out as dividend, it means that the balance 50% is retained earnings, and we have to add it back to what? To retained earnings. And the retained earnings is 5,500. 50% added of retained earnings of 447 for this current year added to retained earnings of 2002 makes total retained earnings 5,977. That is the last additional information. Now let us add the asset side up and add the liability and equity side up to see if it will give us a balance. We all know that the asset side and the liability and equity side must be equal. But in this case, I can see that the asset side sums up to 8,680. While the liability and equity side sums up to 7,977. This one no balance, so it's a difference of 703. We will plug this amount on the liability and equity side of the balance sheet to equal both sides, and we can easily see that the creditors is the unknown figure in the projected year. So the amount 703 is the missing creditor figure in the projected year. For those of us that are a bit confused, calm down. Follow my voice prompt all over again. You would get it. It is quite easy.